Okay, so in this video clip, we're going to set up a bear spread using calls simply by reversing the bull spread we had set up previously. And again, this is going to be up on Vinegar Hill Finance Labs. And the heading you might look out for then is the profit charts and option strategies. Okay, so I'm going to go into the spreadsheet that initially we used to create that that bull spread. What we have here is a bull spread. I want to reverse that and create a bear spread. If I copy and paste everything in, the graph that is created then in the new worksheet is linked to these numbers. So what we've got to do is create a brand new, as opposed to copy and paste. What we can do is just move or copy. So identify the worksheet we want to copy, create that copy. It now shows up over here. And you can see that everything here is linked to the set of numbers we've already estimated in the previous setup. Okay, so in the previous worksheet. Okay, so we'll do a little bit of changing around. Again, just to be clear, what are we creating here? A bear spread. And the bear spread reverses the bull spread so that we, ideally what we should have is a flip of this gray here. So the portfolio or the bear spread, the bull spread is going to flip over and we gain as the stock price goes down, right? So we should be in position. Bull spread is where we gain as the stock price goes up. Bear strategy, bear spread is how we gain as the stock price goes down. Now again, the long becomes a short and the short becomes a long. I'm just changing the labels here. That has no effect. And then the short call position, we're going to say that's long. Again, we estimate the premium here using Black-Scholes. Black-Scholes is actually a nice way of preserving the relativities of the premia, and we just need to flip over. So how do we flip over? Well, what was long should become short, right? Maybe we can leave that as long for a second, but then here we'll say this is the short call. Okay, so remember for this position here, we had a long position, and that basically was the maximum of S minus K, and then we subtracted away the premium from maximum of S minus K, where K was locked. Okay, so very simply, all we've got to do is negative, open brackets, close brackets, return, and we're reversing the position. So what was long is now we're making it short. Okay, and we just drag that down and you can see the effect of what's going on, and we go all the way down. Okay, so we now have we have a short call at the lower exercise, and now we've got to reverse this short call. So this is the short call here, the blue, and we need to make that long. And again, we can remove the negative sign here, remove the negative, right? And we drag that down and you can see it flips around. Okay, so now what do we have? We have previously it was a long call with premium. We've now made that short. And the short call, this was previously short, now we've made it long. And when we take the sum of both of those positions, that gives us our portfolio. And what we have here then is a bear spread, right? A bear spread, just so that our legends are consistent. We will change, so edit the long call to be a short call. We'll say short call position. And again, it's with premium, right? And then the short call becomes long call. So we'll just edit the short call. So what we're calling the short call has now become the long call, with premium, and then the portfolio is the bear spread. Okay, so we have in this bear spread, we have a short call with the lower exercise, a long call with a higher exercise, and adding both positions together yields what we have, the portfolio, which is a bear spread. If we look at this bear spread, what it reveals, as the stock price goes down, we're gaining. As the stock price falls, or as the asset price or the underlying asset, as it falls in value, the payoff on the bear spread improves. So this evidently is a bear strategy.